The next derivative products is future. These financial contracts obligate the buyers to purchase an asset at a pre-agreed price on a specified future date. Futures are traded on the exchange, as the clearinghouse and closing out the position. The risk of future is investors have a risk that they can lose more than the initial margin amount since futures use leverage. Investing in a futures contract might cause a company that hedged to miss out on favorable price movements. Margin can be a double-edged sword, meaning gains are amplified but so too are losses. The third derivative products is options. Options provide the buyer of the contracts the right but not the obligation to purchase or sell the underlying asset at a predetermined price. There are two kinds of options, call and put. A call option in derivative trading gives the trader the right but not the obligation to buy a given quantity of an asset at a given price. A put option, on the other hand, gives the trader the right but not the obligation to sell a given quantity of an asset at a given price. However, to buy any kind of options, you have to pay a premium. The risk of options is in a falling market, the put option seller may be forced to buy the asset at the higher strike price than they would normally pay in the market. The call option writer faces infinite risk if the stock's price rises significantly and they are forced to buy shares at a high price. Option buyers must pay an upfront premium to the writers of the option. The last derivative products is swaps are derivative contracts that allow the exchange of cash flows between two parties. The most popular types of swaps are interest rate swaps, commodity swaps and currency swaps. The risk of swaps is swaps has interest rate risk because interest rates do not always move as expected. The holder of the fixed rate risks the floating interest rate going higher, thereby losing interest that it otherwise would have received. The holder of the floating rate risks interest rates going lower, which results in a loss of cash flow since the fixed rate holder still has to make streams of payments to the counterparty. Thank you for your listening. The next